Good evening, everyone. We're going to get started in a couple more minutes as people are starting to come in. Um, so nice to see so many of you on here. I see my friends Barry up in, well, not up, out in LA in California. I see Aiko in Hawaii, Jeff and Janet down in Delaware. I'm naming like all the states here. Oh, a whole bunch of you in Florida tonight. Of course, Massachusetts is well represented. So nice to see so many of you can make it on to this evening. Hope everyone is doing as well as they can during all of this fun stuff. Hope you're all happy and healthy and families are good. I see John, who started with Mr. Caruso years ago. You know, it's funny, I was thinking about this the other day that, I've been doing this for 26, 27 years now. Dave Caruso was here back and started his in 1979. My father, who many of you might not know, actually started doing financial planning for individuals back in before Dave Caruso. So going way back in time. And as you know, the other day I recognized there was a family that's on here tonight that we recognize that from working with my dad and through all the different things. So my father worked with their father. I work with his children who are not children anymore. They're in their 60s. We're working with their children who now are having children. We have worked with the 4 generations of that family for over the last 50 years. So pretty incredible the amount of time. And we're really humbled that you guys continue to partner with us to help you get to your goals and your family's successes and so forth. So thank you for partnering with us and helping us help you reach your goals. It's really a great feeling. Why we do what we do. We love to celebrate those successes and help you get to where you're going. Just another minute or so. There's a lot of people still pouring in. I think we'll give it another 30 seconds and we'll get started. A lot to talk about tonight, so looking forward. I'm glad you all could make it here on a beautiful fall evening. So one more minute. All right, why don't we get started? Because I started slowing down a little bit, so we might as well get going here. So welcome to our quarterly update with TimeScale. We looked at doing these around 2 weeks after the quarter, usually on a Wednesday or Thursday night. The rules of the game, as we always talk about, is you guys are all muted. Please feel free to send in questions if you have any through the chat or the question box. I will be looking at those, but this time we're gonna do something a little different. I'm gonna hold off on answering questions until the end of the presentation. The reason for that is we had a lot of questions already come in, really good ones, but I think it's important to understand the foundation of what I'm saying in order for me to answer those questions. So I think it'll be great if we just hold off on all the questions and answer them at the end. So, but please submit them in. I'll make sure I go through them all. And let's get going. So today, if I don't know you, I hope I know everybody on here, but if I don't, I'm James Horrocks. I'm a certified financial planner. I'm Chief Executive Officer of TimeScale Financial. Like I said, been helping families for the last 27 years and humbled to do so. This is important. The reason why we're here, we really put these together. Our purpose is to keep you connected to what's going on outside in the world that you're hearing through television, trying to put that in perspective for you. Also to inspire you to continue to feel great about where you're going and how you're getting there. And most importantly, to empower you, to give you that confidence that says, hey, if I just recently retired, I can still get through. Or if I'm on my way into retirement, hey, am I in a good spot? Or just am I at the beginning, just had a child? Are we going to make it to where our goals are? And that's what we're trying to do. Connect you and to inspire you and make you feel, most importantly, empowered and confident about where you're going. Today's agenda is going to be a firm update, like we always try to give you, so that you can understand where we're at as a firm and what's been going on inside here. A market update, talk about all the things that have been going on this year. And this time, we're really going to focus on 3 different areas. One is inflation. The second is correlation between stocks and bonds. And finally, a recession, and how all 3 of these things are affecting the market. And then finally, like I said, answer all your questions. And please feel free to send them in. I will make sure I stay here to answer all the questions that you have. All right, let's go right to the firm update. So on the firm update, as you all know, we had joined One Digital back in May. We are going to be sending out new management agreements to you that need to be signed. It's just an acknowledgement that you recognize that we're leaving TimeScale Financial's RIA and heading over to One Digital's. For most of you, the document will be sent on a DocuSign through email. So all you have to do is sign it on the computer. We will send you an email or call you before that happens. And just to let you know, it's going to be happening in the next couple of weeks. I actually might even say maybe the next couple of months, but we just wanted to give you a heads up on it. Any questions, of course, please feel free to contact your relationship manager, myself, whoever it is. We want to make sure you are comfortable with what it is you're looking for. But this is simply a signing of the acknowledgement of TimeScale Financials, registered RIA, which is an SEC term, to One Digitals. Most importantly, what's not changing? Your advisory team, the leadership team here at TimeScale. I'm not going anywhere. If you're working with some of our relationship managers like Kamei, Sean, Doug, Joe, Mark, those people aren't leaving either. Everyone's staying here. Your account numbers at Schwab remain the same. Your instructions that you may have on your accounts, like any money coming in or money going out, everything remains the same. Someone asked me the other day, what expectations should I see as far as what should I expect to see different than today? Should be very, very little. I've also heard from many of you that, there's so many changes going on over the last several years, and it just seems like there's been an awful lot. Why are we doing this? What is the purpose of all of this? The purpose for why we're making these changes is to make sure that we're constantly meeting our fiduciary responsibility to help you get to the goals you're trying to get to. The industry itself, the financial planning industry, is changing dramatically, no different than the rest of the world, right? 20 years ago, none of us had iPhones. None of us were using smartphones. Maybe we had big flip phones or something like that. But look how fast technology is changing. The investment world is changing fast. I feel it's our fiduciary responsibility to make sure that we're getting the most resources we can to help you get to your goals the most effectively and efficient way possible. Without us growing, if we just stayed stagnant, I don't think we would do that. Many of you knew me when I started in the attic. If I stayed in the attic, I couldn't do and provide the things that we're able to provide you today in this fast and changing environment. It made me think about this is that I thought about too all the different things that we have done recently, and it made me want to put this together for you guys. I want to show you how TimeScale Financial has evolved, because really what's happened is we've been evolving all the time. It just seems like they just some of the changes seem bigger and bigger, but we've been doing it all along. So what do I got? I got a timeline here for you. Look, Dave Caruso, I want to put him as part of this story too. So Dave started in 1979. He was with E.F. Hutton. I started in 1996. I hung a shingle called James Horrocks Financial Planning, and I was sitting in the attic. Well, changes start slow, but in 2008, we started picking up the pace. Dave had already left E.F. Hutton at this point and was over with Morgan Stanley. And I had made the determination that I can't stay in the attic because of the fiduciary responsibility, and I wanted to make sure we had enough resources for you. So we needed to make some changes. That's when Dave and I merged in Coastal Capital. I had changed my name already again to Integrated Financial Partners. You'll recognize I have a little name fetish for some reason. I didn't understand until I did this. But Dave and I merged together, again, to bring scale to the firm so that we could use different resources. On our own, we didn't have the ability to do that, but coming together, 1 + 1 made 3, and we were able to do more things for you. In 2014, we acquired a 401k business and hired Neil Tremblay to run that. He came out of the institution world with State Street Bank, but we thought that was very important because 401ks and retirement plans are a really big part of most people's net worth and what you're trying to accomplish, and bringing that expertise in-house was great. We also hired a woman at that point called Kate Asak to help us execute on our strategic vision. She came from inside the Fidelities and the Schwabs of the world, would provide us perspective on not only about where the industry was today, but where we thought it was going so we could always stay ahead of it. In 2017, this was a big one that you probably remember, most of you, because you got a stack of paperwork like this. So we decided to leave LPL and join and become fully independent. And that's where we hired the custodian of Schwab to handle your accounts and the investment side. But that was a very big transition for us. Dave Caruso implements his succession plan in 2019. He evolves into doing some different things inside the firm. In 2021, here's the name fetish problem I have. We changed our name because we wanted a name. We liked the name Coastal, but in our opinion, it was too geographic. We wanted a name that kind of talked more about what we do and how we do it. We talked to you before about how TimeScale is an actual real word. It's a unit of measure, and we thought it was really unique because everybody we work with has their own different unit of time and measure of things they want to do. The obvious one's retirement, right? Some people want to retire a couple years, 10 years, 5 years, whatever the story is. That's your own TimeScale. We never would have changed our name if we knew in 2022 that we were going to be joining a larger organization called One Digital. But the opportunity with One Digital came along, and again, about resources. We're joining a larger firm now that has more resources that many of you won't see the direct effects of these resources, but it's helping us behind the scenes. It's helping your relationship managers like the Kame's, the Sean's, the Marks, the Dougs, the Joes, to get more things done effectively and efficiently from you behind the scenes. Some of them you will see directly, and those will start to come out in about 3 to 6 months that are going to be hopefully some resources that make your lives easier and helping you get to your goals. But it's about efficiency, helping you get to where you need to go and how we get there. So we've been evolving all along. This really isn't new. I just tried to put some of the highlights in there. There was a lot of other things that went on in between there, but I just wanted you to recognize that we have always tried to put ourselves in the best position to help you. So along with that theme of evolving and growing, we have also added, our team is expanding. We have, please join me in welcoming Sam McDermott. Sam is joining us from MFS, where he spent the last 6 years. He's coming on as a retirement plan consultant. He'll be in our retirement plan advisory group. So we're really excited to bring Sam's expertise to that team. His most recent role is as team leader on the internal defined contribution specialist team. That's a big word for working with 401ks. He's a graduate of Gettysburg College in 2016, and he graduated with a bachelor's in arts and organizational management studies. So we're super excited to add Sam. He's only been here a few days, so if you get the opportunity to welcome him, we'd appreciate it. You know, and the other thing that's really important to us is not just growing. Growing is not just about numbers. What's really important to us is more with the growth comes working with people and families and relationships. We want to be around for those milestones. And we've got the honor of sharing many of your milestones throughout your lives. But we also had some happen here. So our family is growing at TimeScale. So join us in congratulating Mark Sullivan and his wife, Megan, on the birth of their baby boy, Patrick. Many of you work with Mark, so if you get the opportunity to congratulate him, you can see that Patrick is already over 3 months old. He was born in July. I think it was July 4th, but if I'm wrong, July 3rd. But we're really excited. I know Mark and Megan are happy to have Patrick as part of the family. And then also our firm continues to grow as well. Some milestones. We have James Higgins, who's in our operations. Him and his new wife, Candace, got recently married, and they spent their honeymoon in Italy. So we want to congratulate them as well. And those are beautiful pictures of Italy. It makes me a little jealous. I'd like to go there myself, but congratulations to them as well. All right, let's get over to the markets. I'm sure we've all been hearing the news, and it hasn't been a pretty sight. So this is year-to-date performance through October 11th. So Dow Jones Industrial Average is down 19.5. The S&P 500 was down 24.7, and Nasdaq's down 33. What's so unique about this is the bottom one, which is the bond total market index, which is down 15. That's unusual for us. Usually what happens, like during COVID, the market was down 30%, but bonds were flat or basically positive a little bit. We haven't seen such a big down in the bond area. So this is something we'll focus on a little more in a few minutes. But as far as the stock market fall from January to what you're seeing on October 11th, we've seen worse than this. We saw it just during COVID when it was down almost 30-something% just in a 6-week period. Hopefully it doesn't get worse than this, but this is where we stand today. And we're going to talk about how this happened and what are we doing to try to take advantage of those things. And then again, I'm going to focus on the bonds a little bit and talk more about that. You know, we purchase bonds for very specific reasons, and those reasons are diversification, controlling of risk, and also to collect income. So we'll touch more about how this is working inside of bonds, because you're going to say, wow, it hasn't really controlled risk. Look, it was just down 15. But we're going to talk more about that in a few seconds. But what's really driving this market? It's interesting. There are some strengths that are still out there. First, it's consumer spending. Basically, there's a lot of demand out there, and people are still spending money, specifically in travel and leisure. The labor markets continue to be strong. We're at low levels of unemployment, pretty much record lows at this point. There haven't been many layoffs, and there seems to be still a lot of job openings, so that's important. Even though the stock market is down, company earnings have remained really solid. Somebody said to me today, they said, well, you planned this perfectly tonight because the stock market was down. If anyone noticed this morning, about 600, and it flipped all the way to being positive 800. I didn't plan that. If I was that good, I would own an island or do something. But you're seeing a lot of volatility right now. But these are some of the reasons why you're seeing some strengths. Where the risks are probably what you'd expect. There's an elevated risk and concern of a recession. And with that recession also having high inflation, which can result in your real disposable income being lower. What does that really mean? You know what it feels like when you go to the gas pumps. We used to spend maybe $30, $40, $50, depending on the size of your tank in your car. And now you're paying maybe, $50, $60, $70 for that. So it's taking away from the money that you have left over to spend, and it's eroding that. And then we also have the Feds focusing on inflation first. They're very conscientious about trying to make sure inflation doesn't run out of control. So you're seeing them keep raising rates. But what this could do in turn is hurt the labor market, and it could slow down the economic growth, leading to stagnation, which is just flat growth, no production, no GDP growth in the economy. These two risks go exactly against the strengths that are happening now. If we take away disposable income, consumer spending could come down because you don't have as much to spend. We just talked about labor markets could change, and the corporate earnings could also get in trouble because there's no growth here if these risks do happen. So this is what everyone's talking about. This is what's driving the market. What I'd really like to do right now is focus on these three categories of inflation, the correlation between stocks and bonds, and recessions and how they're affecting the market. Because I think this is very important to understand these because they're really the biggest, in my opinion, what's happening in the market. These are the three biggest topics to focus on. First, there's inflation. So we should define it first, right? What is inflation? Inflation measures how much more expensive a set of goods and services have become over a certain period of time. So you heard about the CPI index, actually just came out today. That's 8.2%. What does that mean? What they do is they take a basket of goods, all stuff that we buy in a regular time, back on September 30th. Then they measure it against September 30th, 12 months later. So it's a 12-month number. It's not from January, it's a 12-month number. And what it's saying, those same basket of goods we bought September 30th of 2021 now cost 8.2% more in September 30th, 2022. That's what inflation is. How does this affect stock markets and stocks? Well, potentially because the cost of things are going up, this could bring profits down. So stock market earnings stock companies in the stock market could have their earnings go down, which again means that their valuations would fall. But really the biggest effect this time that we haven't seen in a long time because of inflation is on bonds. And what that means is when inflation goes up, interest rates tend to increase, which drives the price of bonds down. Why is that? What happens is we all understand a CD. So let's just think about a CD for a second. If I bought a CD a year ago for 3 years and I got 1%, that's great. If a year goes by and inflation has happened, I now may be able to get the same 3-year CD a year later and now at 2%. So if I can go out and get 2% right now, but I'm still holding my old CD, right? I'm getting, at 1%, I'm going to get 1% of my money in year 1, 1% in year 2, 1% in year 3, and get all my money back at the end of year 3. I know that's how it's going to work. But if someone could go out into a year later and go get a 2% CD, well, mine doesn't look so good anymore. Now, what happens is, this CDs are traded on the secondary market all the time. You may not recognize that. But if I wanted to get out of my CD, and other than a penalty from the bank, I just mean if I wanted to sell it, and someone can go out and get a 2% today. In order for me to sell that, I have to scream at the top of my lungs, "Hey, it's a deal! It's a deal!" It's no different like a store, right? When they have a sale, 20% off. I'd have to sell that at a discount to attract someone to come buy my CD with a 1% interest rate versus one that's a 2%. It's exactly how bonds work. Well, within reason. If Johnson & Johnson was having a bond that we bought a year ago that was giving us 3% interest, but now a year later you can get the same bond at 4%, we have to, in order to sell our bonds, we're going to have to sell it at a discount. The challenge with bonds is that you see the price changes every day. So that really shows that you see the price falling. for many of you, we'll talk in a little while, inflation going up, especially those close to retirement and the ones in retirement, is actually a benefit to you because the people that I know on this group here have what's called flexible outside money. Inflation is terrible for a retiree if they have a fixed pension or Social Security. But if for many of you, if you have outside portfolios that we've been help managing for you and they remain flexible, when interest rates go up, we can get higher and higher interest rates so we can collect more and more income to provide you at retirement or when you get closer to retirement. Inflation's not awesome for younger people because they are consuming, they're bigger consumers, families of four, driving to work, dry cleaning clothes. Well, no one drives to work anymore, but you know what I mean? You're consuming more stuff. So you are feeling the effects of inflation and you don't really care about interest rates that much as far as collecting interest. You're probably more in the stock market and doing some other stuff because you have a longer time horizon. That's why inflation for my retirees, for all the people here at TimeScale who have flexible portfolios, this can be a positive. Well, let's focus on the bonds for a minute. We were talking about this before. So bonds tend to deliver strong returns in the years following negative return. So this is a really tough chart to see, and I apologize, but I just want you to get the big visual. All these red negatives down here is a period of time when bonds went negative. And then what's following these little dots is these bars that mostly are going up that shows how much the bond performed after a negative period of time. So you'll see that most of these bars are going up. We've only had a couple that have stayed down. And you can see the bond market has got as low as 9% down in the late 70s. And most of the time, we're looking at 7s, 5s, 4s, 3s, and 2s. Well, right now in 2021, we're seeing something a little different. We are actually down 15%. That's a big number. Haven't seen that in a long time. Excuse me. So what's causing this larger drop? Well, one of the things is we've had 20 years basically of very low and stable interest rates around 2%. We have had a long period of time of no inflation at all. So because of that long period of time, when all of a sudden inflation started, it really jumped and it spiked and it's kind of a shock to the system. It jumped 4% in 2021 and has risen to 8.2, like I said, in 2022, and continues to be rising. This has caused a phenomenon that hasn't happened very often, where stock market's going down and the bond market is going down together. They're correlated positively. That means they're going in the same direction and they're correlated positively. Remember what I said before about purchasing bonds. Why do we do it? We do it because we want to have diversification in income. Well, I talked about the income a second ago on the inflation part, but diversification, you're going to say, well, Jim, this isn't diversified. Everything's going down together. And you're right. But let's talk about that. So before I get too far out of my way, ahead of myself, what is correlation and why does it matter? Look, we just talked about it's a statistical measure that determines how an assets move in relation to each other. When a stock market goes up and the bond market goes down or vice versa, that's considered they're moving in opposite directions. And that's considered negatively correlated. And it's really great for diversification, right? Because if the stock market goes down, the bond market goes up, then it's great for diversification. I'm glad I got my hands in different baskets so I can have things doing different things. But when we have them going the same direction, they're called positively correlated. And positively correlated is not great for diversification. So what did I say earlier today? We buy bonds for diversification and income. So if they're positively correlated, Jim, why are we in bonds? What are we doing? Well, stocks and bonds have been correlated positively only 3 other times in the last 94 years. This goes all the way back to 1926. They were positively correlated in 1931, 1941, and 1969. And maybe they'll be positively correlated by the end of the year in 2022, this year to date. This means they're positively correlated where they've gone negative stocks and bonds together and they've ended the year negative together. There are other times like quarters where bonds and stocks in a quarter can be positively correlated. They both can go down or both go up. That happens less than 10% of the quarters since 1926. But for a year, I want to make clear, for a full year, for the stocks and bonds to be positively correlated down or up, it's only happened 3 times. And what's the reason for that? I'm sorry, I should have put this up sooner. And again, so the bonds have only been poor diversifiers with stocks 3 other times in our history. So I'm going to vote on history that this isn't going to happen very often, and we have to drive through this. In order to drive through this, let's look what happened the last 3 times this happened to bonds. And basically, bonds tend to deliver strong returns after something like this happens. And you can see in 1931, 41, and 1969, this is what the bond return was. And then you can see after 1 year, 3 years, and 5 years, strong numbers that are following afterward. We don't know what's going to happen in 22 yet. We don't even know it's going to end out negative. It certainly looks that way, but we don't know how it's going to look after. But if history repeats itself, there are going to be positive and strong numbers that come following within a year, 3 years, and 5. So that's what's so important. I'm going to vote on history here that the bonds continue to be a strong diversifier and will perform well. They just got having this could be the 4th time in 94 years that this happened. So what's a recession? You're hearing about recession all the time, right? Recession is a significant, widespread, and prolonged downturn in the economy. Sounds so formal, right? Excuse me. A popular rule of thumb is when 2 quarters in a row decline in gross domestic product. What is gross domestic product? That's just a measure of what the United States produces. So what it means is that in Q1 and Q2, we produced less than we did previously. The percent change from the previous quarter. So if our previous quarter, we produced this much and now we produce this, that's a decrease in the gross domestic product. When you have 2 quarters in a row that happens, you're technically in a recession. Some people will debate this, but this is the technical definition. So if you're going by the technical definition, we are in a recession. So what does it mean, though, to be in one? Well, we've been in about every 5 to 6 years, a recession happens. And what I did is I put in the last recessions all the way back to 1945. Excuse me. And so many of you asked me, well, how long do these last, Jim? What's the performance then and after and so forth? Well, I put this chart together for you. The average recession, whoops, sorry about that. No idea what's happening. The average recession lasts about 11 months. It's not a very long period of time. You can see the GDP, that's a gross domestic product, averages about 2% down from the previous quarter. But here's the good news, and hopefully history can repeat itself here, where after 1 year from a recession, the market's up 15% on average during all of these periods of time, which we're looking at more than 70-something years. 3 years, we go up 45, and after 5 years, you're 120% return. So again, history keeps telling us here that these things happen pretty regularly, once every 5 or 6 years, especially a recession. But the rebound after recessions, how it comes back, is generally very strong. So what are the takeaways from this conversation today? We talked about inflation, talked about the correlation of bonds, we talked about a recession. While these things are all happening, what's our takeaway? First and foremost, I want to make it clear again that the market environment that we're in is rare. It's only 3 other times in history have stocks and bonds been positively correlated and posted negative annual returns in the same year. It's only happened 3 times. This could be the 4th. Also, historically, stock and bonds tended to rebound after a period of negative returns. We just saw all those charts. History is telling us that they will bounce back and come back. We just don't know when and how long it's going to take. The majority of time, those stocks and bonds are negatively correlated, which helps create a well-diversified portfolio. So what am I saying? This has happened only 4 times out of 94, 3 times so far. This could be the potential 4th time out of 94 years. So I wouldn't run away from the concept of using bonds and stocks together as a well-diversified portfolio just because it may happen 4 times in 94 years. I'll vote on the other 90 years that it was very positive to put the 2 together. So action items, what should we do? Well, let me tell you what we're doing all the time to try to combat all the things that are going on in the environment. First, we've got to make sure your risk levels align with your goals. That's number 1. Number 2 is we take a dynamic approach to your asset allocation. What does all that mean? What it means is we're always looking at how much of your assets is in different baskets. Those baskets are large companies, mid companies, small companies, international, and all the different bonds. We look at that all the time to make sure we're in the right spaces. In fact, we're really deep into it right now. We're considering some changes coming up in the first quarter. based on the changes in the economic outlook. Just so you know, we made a couple years ago some changes to try to combat inflation and risk inside the stock market. What did we do? Inside of our asset allocation, what we chose to do is be shorter on duration. What does that big word mean? It just means that our bonds, we didn't want any of them to mature like a CD. We didn't want any of them to mature too far out. So we wanted them all to be shorter maturities. In fact, our entire bond portfolio, all the bonds that you own in those portfolios on average, all of them would mature in less than 5 years. So we didn't do anything else and just held those bonds. They would all mature in less than 5 years. So we got shorter on duration, which really helped us. The second thing that we do is to make sure that all our bonds are laddered. And what does that mean? That just means that bonds are maturing every month. So every month as a bond matures, we flip it into the higher interest rate to get you more income that we talked about. Excuse me. So the only problem with that, though, is inflation keeps going up. So say we have a bond mature that we were getting 1% and we move it into a new bond that's getting 2%. Sounds great, right? More interest, positive thing to do. But if interest rates keep going up and our 2% bond, now all of a sudden in a few months we can get one for 3%, our 2% bond isn't going to look so good anymore and the price is going to fall. Again, though, that's not why we bought them. We bought them for diversification, which just isn't going well this year as we discussed, but it's 4 out of 94 years, and income. This is helping us on income. So by laddering your bonds and staying flexible and staying shorter on the duration, that has helped our performance in bonds. Even though it's negative, it's kept us from being less negative and where we're going. So we look at those type of examples in every asset class every day. The third thing we do is we make sure we determine first whether or not you need to be rebalanced. We put bands around every one of those asset classes I talked about, large companies, small, international bonds. And if we go outside of those bands, we have to make a determination every quarter if we should rebalance those, put them back in different positions. We look at that every quarter, and the reason why is historically and mathematically, it's been proven out that that's the best way to manage a portfolio. Quarterly rebalancing is similar to annual rebalancing. There's always been a little bit of statistical. They've both been very good. We decided to go quarterly just to be more disciplined about it and make sure that we're making those changes as frequently as we need to. So we take advantages of moments like this. COVID was the best example. If you were a 50-50 portfolio during COVID and the market fell 30%, remember I said bonds were very correlated, so they stayed positive. Stock market, your stock market exposure may drop from 50 to 40. So what did we do? We rebalanced almost everybody on March 30th. We sold the bonds and bought into the stock market. So we always sell high and we bought low, and we bring you back in alignment, back to the first one, ensure your risk level is appropriate. We want to keep you where we said we were going to keep you. But really, every time you rebalance, you sell something high, you buy something low, and vice versa. Because at the end of 2022, what happened after March 30th? The stock market went up almost 60%. You went like this, sold high, bought low. Rebalancing is one of the best things you can do. It's extremely important. So at TimeScale, we're doing these three things on a regular, disciplined basis to always take advantage of the circumstances and situations of our economic environment. What do we encourage you to do? Stay the course. And I know you've heard me say that many times. We cannot predict the future. Nobody can. No one can do it consistently, let me put it that way. But yet, history is on our side. And I'm going to vote to focus on history than I am to try to make some prediction in the future. Because if we're wrong on a prediction, we're really in trouble. If we get it right, great. But if we follow history like we've been doing for myself, 27 years, for Dave, the last, I gotta get the numbers right, almost 45 years before his succession plan. And my father, before he fully retires, another 40 plus years. History has proven to get us there. We are really the tortoise versus the hare. We do the disciplined approach, and we're like this, and we focus on the long term. Television is not helping you. Television is focused on the short term for most of the time. They want to get big ratings, so they, make, if it's down market, it's the worst down market we've ever seen. If it's positive, it's the greatest thing ever. That's all great in the short term. We are talking about long term. So we are the tortoise. There are many people out there that will tell you about all these stocks they buy and how great they're doing and all that fun stuff. Bitcoin, everybody's got to own Bitcoin. That's the hare. At the end of the long-term game, we will win. So I just did a lot of talking, a lot of discussion there. Let's get to some of the questions that came in. So a lot of these came in before. In fact, we got a lot of questions. We try to boil them down because some of them are kind of the same themes. So we boil them down into these areas. Let's start with this one. If the market continues like this, should I still retire this year? So, and that came from our friend B. And then the other question that came after that, I just started my retirement and this loss in principal is scaring me. Do I have to get another job? That's another friend of ours, Jeff, out in Western Mass. So I don't want to give the town away, but so this is a great question. I think the hardest part that I've seen over the years is when somebody first retires or is right close to getting to retirement. Because this, first of all, not only is retirement a big lifestyle change, you're transitioning and doing all these things, but now you've got a whole new way of getting income, right? It's going to come from your portfolio, not from a job. So listen, let me answer the first one for B. The market continues to like this. Should I retire this year? The answer is yes. Well, the answer is we should double check. And I'd still say it's probably 95 to 98% chance you should. There's rare cases where I'd say, maybe it's not good. Usually that's when somebody was kind of on the edge of being able to retire anyway. But B, I know you, and I know anyone that's been working with us, remember, we always look at your projections as worst case scenario. And remember, you're not retiring and taking all your money. What we have to do is get you through a long term. I want your retirement not to be short. I want it to be long. And if it's a long term, again, we're going to go through this. What's going to bum you out is we're going to go through this another 5 or 6 years from now, and then another 5 or 6 years from then, we're going to have markets just like this. But we put you in a very conservative, disciplined position to make sure we can get through these things. So what I would say to you is there's a 95 to 97% chance that yes, you should still be on the same path, but double check with your relationship manager. Make sure and again, get empowered that you're making the right decision. Same thing down with the person that just started retirement and this loss of principal is scaring me. I know it scares you. You don't need to go get another job. Contact your relationship manager. Let's put you right back on the path of where we are and where we're heading. So Jeff, feel good. You're still in a great spot. I do know where you are. You don't need to get another job. The market is tanking. Is there a point at which we should start making changes? This is a great question. I know there's another one. Oops, sorry, jumped ahead. I get this question an awful lot. Many times this is about timing the market, right? Should we get in? Should we get out? And you guys have heard me say many times, it's really tough to time the market because you have to be right twice. You got to get in at this point and you got to get out at this point, be correct when you got out, and you got to get in at the right time. Very difficult to do. So, and the other thing that's interesting about this question I thought of, there was a couple of people back in 2008 that really were struggling with the market falling. And I remember talking to one person in particular almost every day, it's probably every other day, asking me, should we get out? The market continues to tank. Should we get out? Blah, blah, blah. And they got upset with me because my answer was, no, we're going to stay the course. We're staying here. We weren't making changes at that, but this is the wrong time to make changes. We have to kind of hang in there and see and let the market filter itself out and stay here and stay in the right spots. But that really bothered the person. They're like, it doesn't make me feel good that you're just saying do nothing. And then I thought about it and I said, you're right. Because what most people want to do is see a reaction. If something happens, you want to just see us making changes just to look like we're doing something. And most of the time, in fact, if you historically look at all the market performance and stuff, the best thing you can do is do nothing. But it's really hard for us to tell you that. It's a much easier story if I came to you and said, because of this, we're going to do this and this and this. But I'm not going to do it because I know it's wrong. It's actually harder for me to tell you to stay where you are and just keep hanging in there. And when I explained that to this person, they went, you know what, you're right. It is harder for you to tell me that. So if that's the case, you must really believe in what we're doing. And I do. And more importantly, I'm going to skip a couple spots here. Well, I'll go and coincide it with this one here too. This kind of has a similar theme to the last question. I thought bonds are supposed to be conservative, but they're down significantly. Should we move to cash? What can we do to halt losses aside from going to cash? Well, the first thing was about the bonds. They were supposed to be conservative. You're right. They're supposed to be diversified, right? Stocks go down, it goes up. Stocks go up, they should go down. But you just heard me say could be the fourth time in 94 years that they're correlated together in the same direction. But the other answer was when we saw those last 3 years, the rebound was pretty significant. We're not going to move to cash. We're going to, like I said, stay the course and follow history. Because again, we'd have to be right twice. Just like this person down here who asked, if we have to halt losses, how can we do it besides what can we do to halt losses aside from going to cash? Right now, all asset classes have been hit really hard. There aren't many you can run to that are really positive. Gold, which normally you would say in a high inflationary period with a recession and inflation and everything else, that should be going up. Nope, it's down as well this year. So there really is no asset class to run it high to. But again, running to cash, you got to be right twice. You got to get out right and then get in at the right time. Why is that so important? I'm sorry, I'm going to skip ahead of you. And I want to show you something really quickly. You guys have seen this chart before if you've done these quarterly reviews with us. This chart is talking about if you invested $10,000 into the market starting in 1980 all the way up to March 31 of 2020. So March 31 of 2020 is when the market really came down. I just said to you, that's when we rebalanced. The market was down over 30% at that point. But what this chart is showing you, that in that 40-year span, which I don't remember how many market days that is, but it's a lot. That 40-year period, if you just missed the 10 best days, 10 out of 40 years, you would missed out on 55% of the market growth you should have gotten if you just stayed in. 10,000 would have grown to almost 700,000 here. You missed 10 days, you only have 300,000. 55% of it's lost. What's more important about that is the best days in the market generally come off of the bottoms of the market. They don't come after you got out of the market. Let's say you got out and you got lucky and you got it right and the market went straight down. But if you don't get back in down here, the best days are coming off the bottom. And if you miss those 10 days, you miss 55% of the whole deal. So you got to get back in at the right time. And that's really, really hard to do. Because many of you say to me, well, I'll get out now and I'll get back in when things start looking good. By the time things start looking good, it's back up here somewhere and you missed the 10 best days. All right, I'm bringing you back. Hope I'm not making you dizzy. Another question came in is, in light of the economy going into a recession and going down another 20%, should we put money into a government tax-free bond where we can net about 9% for the good part of the portfolio? So first and foremost, this just goes back to my timing question. We're not going to try to time anything because we don't actually know if we're going to go down another 20% or not. Maybe we're at the bottom today. I don't know. But if we are, and I pull you into cash and go get this 9% that we're talking about, we'd have trouble getting back in, right? We would miss all of the up that's coming up. We'd miss 55% of the growth. Excuse me. The other thing here that they're talking about, I believe, and it comes to this bottom question too, should I be buying I bonds to defend against inflation? Look, I bonds have become very popular. We've been out talking to everybody about them. I bonds can be very good, but let's talk about what an I bond is. And I think that's what this person was talking about, government tax-free bonds where we can get 9%. I bonds are the old series double E's. It's the new series double E's. So remember those double E bonds that maybe you got from your grandparents or something? This I bonds is just like that. It's just a new world of a new version. And what it is they have a base rate that's usually extremely low. And then what they do is every 6 months, they look at what the inflation rate is, and they give you that rate on top of your base rate. But it's against the same type of thing like CPI index. They look at from November to April. What has changed there? And that's how they reset your bond. What's the reset every 6 months, November and April? So what's the issue with I bonds? So a couple of things here. There's some positives and some negatives. First positive is, first negative is you can only do $10,000. I'd love to get 9% on all your portfolios right now, but you can only put 10,000 at a time. The second thing is the money is 100% locked up the first year. You can't get out at all. Between years 2 and 5, you can get out, but you pay a 3 months of interest and penalty. The third issue is, this is a positive, it does grow tax deferred for you. You pay tax when the money comes out. So that is a benefit. The challenge here, though, is I think your 9% rates are probably going to start to come down a little bit unless inflation continues to heighten. Because, again, it's measured over a period, your basket of goods over a 6-month period. And those goods are not going to keep going up 9% every day, every 6 months. If it does, we have another bigger problem. So two things about these questions. Number one, I think I bonds can be really good in some instances. If you have emergency funds sitting around and you don't use, $10,000 or $20,000 because you and your spouse or partner, you may consider putting them in an I bond. Just understand the rules of the game. Number two, though, is we're not going to sell anything because we think that the recession is going to bring the economy down or the stock market down further. We don't know that. We're not going to try to time the market and take our money out of the stock market and put in these government tax-free bonds. I don't think that's the right way to go. Some people have asked, should we sell some of the bonds and get these 9%? You don't want to sell the bonds while they're down. Allow them the ability to come back. Allow them the ability to mature, and then we can flip them to these higher rate bonds. Believe me, every time we're buying bonds, we're getting higher rates similar to what you're seeing here. Is there anything I should be doing before the end of the year? This is a great question. When the market's going down, we got to take advantage of things, like I said, take advantage of the environment, take advantage of the things that are going on. What's really great about this period of time is we can do something called tax loss harvesting. We do it for you every year. We look at doing it for you every year. Like last year, there wasn't a lot of opportunity for that because the stock market was straight up. But what we will be doing toward the end of the year, usually we do it in the mid-December range, is we will look at your portfolios and try to harness losses. So what does that mean? If you put $100,000 into an investment and it's down 50%, you have a $50,000 loss if you sell it. So what we will do is we will sell it, capture that loss. I'll talk about what we do with that in a minute. And then what you can't do is you can't go right back in the next day and buy the same stock. You have to wait 31 days. So what we do is we find an investment that matches the investment you had the loss in, hold that so that your portfolio risk stays intact, but we can capture that loss. So back to my example, we got this $50,000 loss now without changing the risk level in your portfolio, keeping everything the same, but we captured this loss. We will hold that loss until someday down the road that you'll get a gain of $50,000. So if you get a gain of $50,000, you're allowed to take losses and they can carry forward. So it doesn't have to happen in the same year. We can take that $50,000 loss, match it to the $50,000 gain, and now you'll pay no taxes on that capital gain. It's important to harness losses at this time when markets go down. We did the exact same thing in 2020. We harnessed a lot of losses for people so that when we had to rebalance at the end of 2020, we had the losses to offset it, so we kept our tax liability to a minimum. Extremely important to do. We do it all the time. We look at it every year, and we're going to do it again this year. So that's what we can do. Anything on your side of the table that you can do? Look, not much. Stay the course. Stay focused on your long-term goals. Don't let television, media, all that stuff get you focused on the short term. Remain on your long-term goals. Those are all the questions that came in. I just saw a couple that I did answer that were similar to these. If you guys have more questions, please contact your relationship manager or myself. We want to make sure, like I said, if you are staying up at night because this is making you crazy, you're not alone. Happens to many people. But please contact us. We don't want you to feel uncomfortable. We want to empower you and inspire you to feel like you're on the right track to continue to reach your goals. And speaking with that, to keep you on track, we have 2 webinars coming up right here in the near future. October 25th, 2022 at 6 p.m., we're going to be doing planning for Medicare, the countdown to 65. I know a lot of people don't want to count down to that, but it's coming anyway. We can't stop time. But we want to help you with Medicare. We're bringing along Susan Flanagan, she's done this several times for us. She's from Blue Cross Blue Shield. She's going to go over the Medicare, all the supplements, all the plans, all the Advantage plans, how it all works. So that's a great webinar to look at for Tuesday, October 25th. Then on Tuesday, November 15th, we're going to do the same thing with Social Security. Mark Sullivan's going to take you through and talk to you about some of the nuances of Social Security and how you should be viewing it. So please be on the lookout for those. We send those to you through our TimeScale newsletters. So please look for them in there. I know for some of you, you see it and you don't always recognize that these things are there. They are. So please be on the lookout. Also, I can really just want to thank you all. First of all, for taking the time out tonight to be sitting here and listening to me, but caring enough to be listening to us so we can help keep you connected, inspired, and empowered. We are humbled to be working with you for decades upon decades. And for the new people, we hope to be saying that decades and decades from now. But remember, we're here for you to help get through this. Please call us. Don't stay up at night. It's better if you call us. We'd rather know that you're having a tough time so that we can work through it with you. As always, our disclosures, but I want to thank you. Hope you all have a wonderful evening. And we'll look forward to seeing you next quarter, but hopefully we'll see you before that somewhere along the way.